Hey, what's going on, guys? Welcome back to my channel. This is Blood Phantom 81. In this video, I'm going to be talking about the industrial sector and basically do a market overview as I've done with REITs and financials. You guys can go ahead and check out those videos. They will be in the description down below. So in this video, as I mentioned, I'll be looking at industrials, which is actually a much easier sector to digest and look into than financials, in my honest opinion. So we'll take a look at that. I'm pretty excited to do this video. I want to make a quick announcement though. I do have a Patreon where I basically post more exclusive content. I do portfolio reveals, and I also do sort of like blog posts. So you can think of it as like a blog that you can subscribe to as well as support the channel in the process. So it's $1 a month. Feel free to check that out. It's also going to be in the description down below. And with that out of the way, let's go ahead and take a look at some of these industrials. All right, so I'm going to look at industrials from a technical perspective, and then I'm going to do basically look at some industrials that I'm actually buying and I think are still good buys. And then after that, we're going to do a case study on some industrials. So basically a lot of industrial stuff. Anyway, so from a technical perspective, right? So yeah, it's actually pretty plain vanilla. The industrial sector actually looks really similar to the Dow Jones if I had to compare it to any individual index. Obviously, that makes sense. Dow Jones is inherently more industrial and less tech than the other sectors. And so, yeah, pretty standard drawdowns during recessions, you know, anywhere from 40 to 60% between each of these respectively. And then back here in the March crash, they actually did suffer quite a bit. So there wasn't a sense of value, or there wasn't a sense of defensive qualities when it came to industrials. And they actually came and sort of retested the 200-month moving average. As I mentioned, though, I do want to sort of get this video out already because it sort of seems like industrials are already close to getting back to all-time highs. So we are above the 0.786 retracement, and we are, I believe, something around like 10%. Yeah, about 10% or 11% away from all-time highs, right? And so the question is, are there still value stocks when it comes to looking at the industrial sector? In my honest opinion, there are, and we're going to go ahead and take a look at some of those right now. All right, so the first stock we're going to be taking a look at is 3M, and it's actually kind of an obvious one, but I still feel like it's hard to make a video about industrials without actually talking about 3M. 3M is sort of like, if I don't have it in my portfolio, or especially for long-term investing, then I kind of see it as like an obvious miss. So this company, in my opinion, is sort of like a cornerstone, has a lot of awesome qualities that we'll take a look at. For now, let's take a look at it from a technical perspective. So in the 08-09 crash, as well as the 2020 crash, 3M sort of bottomed at its 200-month moving average, actually, as you can see. And so from a long-term perspective, the trend is obviously still intact. It very much respects both of these moving averages. And at the moment, we're sort of hovering slightly below the 100-month moving average. It's been holding as resistance for a few months now, but I do think that 3M is going to close above it. And I honestly think that this was the bottom. I don't see us retesting this or getting below this, at least in the short term. And so, yeah, I think now is a perfect time to be scooping up 3M in case you haven't already. Now, what exactly is 3M? 3M is sort of like a technology company, at least that's kind of what they consider themselves. Technology has revolutionized every single sector and industry, as we've talked about. And so, yeah, 3M is no exception. It's actually at the cornerstone of their innovation. They spend quite a bit of money on research and development, as we'll take a look at later in this video. Just for some quick highlights, so they currently pay around the 3.5% dividend yield, which is actually really, really good. On top of that, they're actually growing their dividend at a really respectable rate. So they're definitely no slouch. And it's really hard to find a combination of, you know, high dividend yield and high growth rate. And so 3M is sort of the complete package. When most people think about 3M, they really think about the consumer products, such as Post-it notes and tape and other office supplies, but they're actually so much more than that. So they have 4 segments, which we'll go ahead and take a look at right now. There's safety and industrial, transportation and electronics, healthcare, and lastly, consumer, right? So most people just think about the consumer. So speaking of safety and industrial, that basically consists of, you know, personal safety, adhesives and tapes, abrasives, closure and masking systems, electrical markets, automotive aftermarkets, and roofing granules. So that's basically not your everyday products, right? This is mostly for companies that are, you know, doing repairs, home improvements, actually building structures and things like that. Just very heavy, your typical industry type products that are usually not accessible to the public sometimes, right? So transportation and electronics consists of electronics, automotive and aerospace, advanced materials, and much more. So nothing too crazy about that one. And they actually operate in healthcare as well. And they recently made an acquisition of a healthcare company back in late 2019, which we'll go ahead and take a look at in just a moment. But the healthcare segment basically includes medical and surgical supplies, skin health and infection prevention products, oral care solutions, and a few other things. The electronics and energy segment involves optical film solutions for electronic displays, packaging and interconnection devices, insulating and splicing solutions, etc. And lastly, the consumer segment, which is the most popular one, that includes office supplies, office supply products, stationery products, home improvement products, and much more. So they basically have literally thousands of products and thousands of patents on innovation as well as the products themselves. So 3M is basically a company that you don't really have to babysit, in my opinion. It's basically like an entire ecosystem in its own right. They put a lot of thought into what they acquire next, whether it's good for 3M's brand and whether it's good for them in the long run. And they also, put a lot of thought into what they're going to innovate on next. And so an ecosystem of so many different companies, when you buy 3M, you're buying a very diverse package, so to speak. Let's go ahead and take a look at some of their, some of their strategy. All right, so this is 3M's key pillars of the portfolio prioritization model. Now you might be thinking, what do you mean by portfolio, right? Isn't 3M just one company? Well, we're talking about the portfolio of 3M companies and the products that they own. So that's basically their portfolio. So it's basically divided into two: strategic attractiveness and financial attractiveness. So does it make sense from a strategy perspective, and do the financials make sense? So there's basically two things that I want to touch upon. The first is technology, right? So when it comes to technology, they only look at technology that enhances the core and can be advanced by 3M. So it has to be something that they can actually advance. It can't just be some random technology. And in terms of businesses, they want businesses that benefit from or enhance 3M's manufacturing strength. They also want businesses with global potential that benefit from or enhance 3M's local sales and operations. So this is basically globalization. And they want brands that enhance or is enhanced by global 3M brand strength. From a financial perspective, when it comes to deciding what to invest in, they basically look at market size, market growth, market profitability. They look at growth and profitability and ROC in terms of financial performance. So this is financial attractiveness from a market perspective and just a raw performance perspective. And so what's interesting is that these metrics are actually what we should be looking at when we're thinking about investing in the company. And so it's good that 3M is actually taking that initiative to sort of do a pre-screening on their end. As I mentioned earlier, 3M recently acquired a company called Acelity in late 2019, and this is basically them. What it does is it expands their presence in advanced and surgical wound care. Acelity is a leading global technology company focused on advanced wound care and specialty surgical applications. And you can go ahead and pause the video if you want to take a look at some of these financial metrics. But this is just an example of the type of company that 3M would acquire. And so it's nice to know that they're still making acquisitions quite often. And so Acelity is no exception. So as I mentioned, 3M sort of considers themselves a technology company, and it's also what we should consider them, honestly. So they put a lot of focus into technology and intellectual property. It's actually what has allowed them to stay so competitive over the past decades, right? They are a dividend king, and in order to increase your dividends for over 50 consecutive years, you have to have some kind of competitive advantage. And so 3M obviously has that. They have over 100,000 patents obtained throughout its history. And as I mentioned, they consistently invest in R&D, which is research and development. And so every year they invest at least $1 billion into R&D, which actually makes up around 6% of their annual sales. So that's actually quite significant for folks that are looking at R&D. And one thing I want to mention about industrials in general, it's probably a good time to mention it now, is that when it comes to industrials, you're very much at the mercy of, well, for most companies, you're very much at the mercy of how the overall economy is doing, right? That kind of makes sense. That's what industry is. Industry is fueled by economic growth. So, how's the housing market? How's the job market? All these things contribute to that, especially like wages, and so You really want to look for companies that can secure dividends even throughout recessions, and there's quite a few of them in the industrial sector, so you sort of have your pick. That's something I want to take note of. And yeah, and the other thing about industrials is they're usually like legacy companies, like the ones that make it generally have made it for a while now, and so that's another reason why it's so easy to basically take your pick. And so let's go ahead and move into the next company. So the next company actually probably doesn't need much of an introduction either. That is Caterpillar, ticker symbol CAT. And so we often associate Caterpillar with also like industrial, things like heavy machinery, heavy equipment, and that sort of thing. We've probably already seen as we're driving down the road, and let's say there's some kind of repair, we've probably seen a Caterpillar branded machine of some sort. And so that's what Caterpillar is. But again, there are actually a few things more than just providing the equipment. Let's first take a look at them from a technical perspective. So similar to 3M, I didn't actually change any of these moving averages. Caterpillar also bottomed here during the March crash at the 200-month moving average. That's also where we bottomed here in 2016, where the rest of the market took a hit as well. And that's where we bottomed here in 2009. And so obviously the uptrend is still intact. And like 3M, Caterpillar also respects these moving averages as well. So just for some highlights, Caterpillar is actually increasing their yield quite often, obviously every single year, and they have a 3% dividend yield, which is actually pretty significant. So anything above 3% plus on a dividend aristocrat or dividend king is something that's rare to find, and so that's what makes Caterpillar and 3M so special. Now, as I mentioned, most people associate Caterpillar with just the construction industry. That obviously is one of their segments, but they actually have a few others, as we'll go ahead and mention. They actually have about 5. So the first is construction, the second one is resource, the third is industry, energy and transportation, the fourth is financial products, and the fifth is sort of like a miscellaneous segment, which is called all other. And so you'll see what I mean in a second. So obviously the first one is construction, which is their largest and most popular. So that is machinery in infrastructure and building construction applications. The second one is actually quite unique. So this is a resource segment, which is responsible for supporting customers using their machinery in mining and quarrying applications. And it includes business strategy, product design, product management and development, manufacturing, marketing, sales, and product support. And so basically they want to make an entire ecosystem of using their products, and they want to help out their customers extract as much value from Caterpillar as possible. And obviously what that does is that builds a very good relationship between 3M and their customers. Obviously they can get referrals from that. Most importantly, I think it's important to just learn from their customers and grow as a company, right? Obviously it's very difficult to lease heavy machinery if you don't really know what you're doing. And so it's nice that Caterpillar has sort of thought that far ahead. The third segment is energy and transportation, and that supports customers in oil and gas, power generation, marine, rail, and industrial applications. So that's pretty plain vanilla. The fourth is financial products, which is probably something that most people didn't think about. But what that basically is financing alternatives for when you want to use Caterpillar's machinery and engines, as well as other equipment. And then the fifth, as I mentioned, is sort of like a miscellaneous all other segment, and that includes more activities in the resource segment, like business strategy, product management and development, as well as other miscellaneous products like filters and fluids, undercarriage, tires and rims, engagement tools, and fluid transfers. And so basically to my point about industrials being very dependent on how the economy is performing, so Caterpillar actually did take quite a significant hit here in 2009 in terms of EPS, where they saw a 75% decline, which is actually pretty significant. Obviously, they recovered very quickly, where in 2010 their EPS rose once again by 190%. So that's something to keep in mind, right? I still think that Caterpillar is sort of recession proof. To be honest, I'm not sure though, right? I mean, I'm just trying to report these sort of ideas and trying to be as transparent as possible with the risk provided. If I'm being completely honest, I think like if Caterpillar were to cut their yield, it would have to be really, really nasty recession. In 2019, which is actually pretty recently, they actually increased their yield by about 20%. They regularly return value to shareholders in terms of share buybacks and obviously in terms of paying dividends. where here in 2019 Q3, so around this same time, they purchased about $1.2 billion worth of stock and returned about $600 million through dividends. And so they obviously value their shareholders. I don't think it's worth taking a deeper dive into Caterpillar. You guys probably already know what they are. But yeah, I mean, they're also a global company, right? They're not just involved in the US, and being so massive, it gives you some advantages in terms of scale and profit margins, which actually is maybe more relevant with the next company, which we'll go ahead and take a look at now. And so the last company I wanted to take a look at is an industrial company by the name of AOS, or basically A.O. Smith. So A.O. Smith, right? This probably is one of the most boring companies that I could actually recommend. Maybe some folks haven't even heard of them. I'm buying them quite happily at these levels. Still showing somewhat of a discount relative to the 52-week high. And as you guys can see, between 2012 and about 2018, they sort of got ahead of themselves, where A.O. Smith actually gained about, what is this? Yeah, that's a huge amount. So around 740% of an increase between 2011 and 2018, which once again is a pretty massive amount. And so they started to correct from that. And what separates A.O. Smith from a technical perspective is actually they didn't even retrace all the way to the 200-month moving average, which to me is a more bullish sign, right? They didn't need that deep of a retracement. And the slope of these moving averages are a lot quicker, or a lot steeper, meaning that the trend is a lot quicker. Not that that should make a huge difference in investments going forward. I just wanted to point that out. And obviously A.O. Smith is very much respecting these moving averages as well. It's always been above the 200-month moving average since their inception. And so how I classify A.O. Smith is basically, yes, they're an industrial product. It's almost borderline like a utility type company, as I mentioned. But yeah, so A.O. Smith, they're basically involved in water heating and purification products. Purification in terms of water and air. And A.O. Smith is actually the world leader in water heaters. They actually represent the majority, or not the majority, but they have about 40% market share of water heaters in the United States, which is actually 10 percentage points above the closest competitor. And to me, I don't really mind boring in that sense, right? If we're talking about a market leader in an industry where I guess you could say they have a really good moat, it'd be hard for any competitor to come and try to steal market share. When you have a market leader, I don't consider that to be too boring. And in fact, what we'll see in a second is A.O. Smith actually has some growth prospects in the future. But yeah, whenever I think about investing, I'm always thinking about market leaders. And so A.O. Smith obviously fits the bill. So they're paying around pretty much close to a 2% dividend yield, which obviously isn't as high as Caterpillar or 3M. However, their 5-year growth rate is a massive, close to 25%, obviously. And don't pay attention to this. This is just seeking alpha sort of being inconsistent. They are, in fact, a dividend aristocrat, and they're paying around the 52% payout ratio. So one thing I want to take a look at is their segment revenue. So A.O. Smith is split into two segments, as we talked about, North America and rest of the world, where North America makes up the majority of their sales, and rest of the world makes up sort of like a 36%. You could think about it as like 2/3 and 1/3 split. This was in 2018, but it's actually pretty similar today, although the rest of the world segment is growing. And these are some of their subsidiaries, so Aquasana, etc. Obviously, all these have to do with either water or purification. And as I mentioned, A.O. Smith is growing at a pretty respectable rate. So one thing I'll say is take this chart with a grain of salt, because anything that shows growth since like 2008, 2009 will obviously have a pretty nice, upwards bias, because that's when the economy picked up. But still, on average, they're 10%, on average in terms of sales, they have about a 10% compound annual growth rate, which is actually quite impressive for a company of their scale. And so one highlight I want to make is basically their China market. And so anytime you have companies that are global and part of, I wouldn't say developing countries, but I mean, obviously it includes developing countries, but companies that are growing their economy basically. And so China fits that bill. Anytime you have companies that are invested in those opportunities, it usually represents good, growth in the long term. And so I'll go ahead and basically present this information. So China represents a major long-term opportunity for A.O. Smith. Obviously, the growth is apparent. So China now contributes over $1 billion in annual sales for the company and has been growing at a high rate. Sales in China rose more than 20% each year in a 10-year period through 2017. And obviously, you guys can see sales in China actually hit about $1 billion back here in 2017. So that's actually really, really impressive. One of the reasons for China being such a good market is their air quality and water quality actually isn't the best. And so A.O. Smith has a really good leg up there. Obviously, that's their market. And so, yeah, as I mentioned, so they have the #1 market share in the US for water heaters. They have about 40% domestic share, as I mentioned already. And one thing about really large companies is when you're a company of a certain size, especially when you're a market leader, what that means is you're able to increase margins through networking, through other relationships, and you basically just have other competitive advantages that smaller competitors do not have. One of those advantages is actually that they are the sole supplier of Lowe's for water treatment products. And so that is a huge deal. And so obviously it's good for both of them in the long run. And basically what I want to point out here is this paragraph, which is possessing the top industry position gives A.O. Smith pricing power and high margins. In turn, this provides the company the ability to generate lots of cash flow, which enables it to invest in new product innovation. And I'll wrap up my A.O. Smith by saying, once again, it is also dependent on how the economy is doing, which I've said a few times now. But not all industrials are as dependent on economic health. And so you might be scratching your head and be like, what are you talking about? So that's what the case study is going to be about. What I'm going to be comparing is some defensive and aircraft giants by the names of General Dynamics and Lockheed Martin. So General Dynamics right now is showing an amazing buying opportunity in my honest opinion. Once again, it looks like we're bottoming here at the 200-month moving average, which is also where we bottomed here in the 2009 recession. We've already recaptured the 100-month moving average, and it looks like we're holding it as support. Again, with all these other industrials, I don't anticipate us to actually get below this level, so I think the low is in, so to speak. Lockheed Martin, on the other hand, isn't showing that good of an opportunity relative to its 52-week high. In fact, it actually looks like it's performing quite well. And it's probably one of the reasons why the industrial sector is zeroing in on their all-time highs once again. So in terms of what they actually do, there's not that much that distinguishes both Lockheed Martin and General Dynamics, at least not in the sense that's probably worth discussing, I would say. So let's go ahead and take a look at some of their business segments. So we'll start with Lockheed Martin. So what they do is aeronautics, missiles, and fire control, which is like projectiles, rotary and mission systems, and space. And then if we take a look at General Dynamics, so they operate in aerospace, which is basically similar to space, combat systems, information technology, mission systems, again, Lockheed also has this, and marine systems. So not just air, but also marine, as well as, IT, mission, and space. So like I said, not that huge of a difference between the two. And what I do want to compare is their financial metrics. But before we do that, I just want to give a disclaimer. Obviously, not everybody's like comfortable with investing in aerospace and defense companies for good reason, right? I mean, it's not like it's used. I mean, it's debatable, right? So I'll go ahead and discuss that later on in this video. But as I mentioned, first, let's go ahead and take a look at some of their financial metrics. So we'll start really simply with their dividend yield. So General Dynamics has a 2.81% dividend yield, and Lockheed Martin has a 2.4% dividend yield. So General Dynamics actually wins that one. And so now what I want to take a look at is their valuation and value that you'd be getting if you were to purchase one share of Lockheed versus one share of General Dynamics. And to give you guys the summary, General Dynamics actually creams Lockheed Martin in the metrics that we're going to be talking about. So they are the better value, at least from the surface level. Obviously, there's more research you can do, but let's go ahead and take a look at some more popular ratios. So General Dynamics has a 13.4 trailing PE, while Lockheed Martin has a 17 trailing PE. I'm going to say GD because General Dynamics is actually hard for me to say for some reason. So in terms of forward PE, GD has a 13.59. forward PE, and Lockheed has a 16.1 forward PE. In terms of price to sales, GD is 1.13 and Lockheed is 1.17, so GD wins that one. And in terms of price to book, GD has a 3.12 and Lockheed has an atrocious 28.91. And so, like I said, there's more research you could do, but these are just like service level metrics. I think like if it was any closer, I would have done a deeper dive, but I think that's fair to say that you are getting more for your buck in terms of what you would if you were to purchase GD versus LMT today. And so yeah, as I sort of hinted to earlier, not everyone's comfortable with investing in aerospace and defense companies. I personally, I don't even invest in like Altria, for example, even if I consider it an okay investment. Like I don't like cigarettes, and I totally understand people have a right to do whatever they want to do with their bodies, but that's sort of where I draw the line. Like I consider cigarettes to be different than like alcohol and fast food, even though none of those things are technically good for you. I feel like it's possible to do alcohol and fast food in moderation more than it is cigarettes. Cigarettes are basically designed to be as addictive as possible. That's why they sell as much as they do. And yeah, I don't think it just seems like a way less casual thing, right? And it's very much life changing once you get hooked. So for that reason, I don't invest in Altria, and so I don't blame folks that don't want to invest into these defense companies, which are basically, making it possible for, the government to be a global leader in war. Um, the other thing that reminds me of is, so while these companies are sort of more recession proof, which is obviously a huge plus, there is sort of that risk, which is whoever's in office or basically whatever the current administration is might put less of an emphasis on spending or basically this kind of budget. However, honestly, I think like the government has a bottomless budget when it comes to defense. It's been this way for a while, and I don't really see it changing. I think the U.S. has sort of decided this is the role that they want to play with the rest of the world. Especially ever since World War II. So I don't envision this changing very much. And in addition to that, the moat here is pretty massive. I doubt there's going to be another company that's going to steal any kind of market share from any current defense and aerospace companies. That is a really, really brutal industry to try to get into. So good luck. So, if we were to just, isolate everything, put it in a vacuum, GD is something that I'm buying and something that I think is a good investment personally. Obviously, you guys saw the buying opportunity it has right now. So, yeah, I'm happily buying it. And from a moral perspective or from a value perspective, I'm talking about like ethical values, it makes sense to me. So that's why I'm okay with purchasing it. But yeah, I totally understand if not everyone is, and that's okay. But that's where I'm going to wrap this video. So hope you guys enjoyed the case study. It was probably a little bit different, less technical, maybe a little bit more ethical, and that's okay. And I hope you guys enjoy the rest of the video though, and I will see you guys in the next video.